looking at auditing a journal entry, guys. What is a journal entry? You're going to be debiting something and crediting something. Okay, often it's one thing. And so when you are doing a journal entry, it's generally testing for a transaction, or it's an adjustment to an item, which then is for valuation. Potentially fair value adjustments, it's depreciation. So ultimately looking at potentially your subsequent measurements. If you ask to audit a journal, remember you've got two elements. So go and test that the debit and the credit was actually recorded. And something like where the debit or the credit is bank, you can go and trace it to the bank statement. But if it is a transaction, use your class of transaction assertions, all of them, completeness, accuracy, occurrence, cutoff, and classification, because you're going to have a date, the description, and the amount. And so we can test all of those. Sorry guys, the one thing I didn't want to put here was completeness. Don't test for completeness because it's one transaction. So you don't have to test that there are items that have been left off, because you can see the one is recorded. And that's what completeness is doing, is that they haven't recorded something, but it's there. So we don't have to worry about that. When you're looking at an adjustment, it's generally going to be for the valuation assertion. So now you're going to want to focus on that rand amount and that calculation to get to that value. Okay, so don't get thrown. We're not necessarily now going to look at the entire account balance, because you're not worried about existence of items or completeness of items, because it's one journal entry. And so you're going to focus just on your valuation assertion. So guys, we've now done the balances and transactions that are in the cycles, and we've looked at auditing a single journal entry. Now we need to consider what happens if any of these are actually between a related party. How is that going to impact the audit and the audit procedures?